Hello and a massive welcome back to Earnternet, the podcast where we untangle the complicated world of money and make it make sense. I'm your host, Jennifer.
And I'm Sam. It's great to be back with all of you. Today, we're tackling a huge one, a piece of advice so common, so deeply ingrained in us by our parents, our grandparents, and society that questioning it feels wrong.
It feels almost rebellious, doesn't it? We're talking about the golden rule of personal finance, the one thing everyone tells you to do from the moment you get your first dollar, and that is save your money.
Exactly. And I'm here to tell you and everyone listening that in today's world, simply saving your money is quite possibly the worst piece of financial advice you can follow if your goal is to build long-term wealth.
Okay, hold on, Sam. You just dropped a bomb on the entire foundation of personal finance. The worst advice? Are you telling people to be reckless, to spend everything they earn? My grandma would be having a heart attack right now. She kept cash under her mattress.
I know. It sounds crazy, and I'm definitely not saying spend every penny. But the just save it mentality, especially keeping large sums of cash in a standard, low-interest savings account, is a guaranteed way to lose money over time. Not on paper, but in reality.
Lose money? But the number in my bank account only goes up when I save. It never goes down unless I spend it. How can I be losing money if the number is getting bigger? That doesn't make any sense.
That is the perfect question, Jen, and it's the trap almost everyone falls into. We look at the number, the nominal value, and we feel safe. But we're ignoring a silent, invisible thief that is constantly eating away at our savings. And that thief has a name: inflation.
Inflation. We hear about it on the news all the time, especially lately. It's when prices for things like gas and groceries go up, right?
Precisely. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently the purchasing power of currency is falling. Let's make it super simple with an example. Jen, think back to, say, 10 years ago. How much was a decent cup of coffee from a coffee shop?
Maybe $3, $3.50, something like that.
Okay, let's say $3. And what about today? That same cup of coffee is probably closer to $5, maybe even more in some places.
Yeah, easily $5. My morning latte is definitely proof of that.
Right. So let's imagine 10 years ago you decided to be responsible. You said, I'm not going to buy this $3 coffee. I'm going to save that $3. You take that cash and you put it in a piggy bank or a savings account that pays basically zero interest, which most of them do. You feel good. You feel smart.
I feel responsible. I have my $3.
Fast forward to today. You open that piggy bank. Your $3 is still there. The number hasn't changed. You haven't lost any money, right? But what happens when you take that same $3 to the coffee shop now?
I can't buy the coffee. The coffee is $5. I'm $2 short.
Bingo. Your money is still there, but what it can buy has decreased. Its purchasing power has been eroded by inflation. You didn't spend your money, but you lost buying power. In the real world, that is a loss. Your savings have become weaker. Now, multiply that simple coffee example by thousands of dollars over decades. It's a financial disaster playing out in slow motion.
Wow. Okay, when you put it like that, it's actually terrifying. So my money in a savings account is like a block of ice on a warm day. It looks solid, but it's constantly, silently melting away.
That is the perfect analogy. And most standard savings accounts pay an interest rate of something like 0.01%. Meanwhile, inflation, on average, has been around 2 to 3% historically, and sometimes much, much higher as we've seen recently. So if your money is growing at 0.01%, but prices are rising at 3%, you are getting poorer by 2.99% every single year. You are running on a treadmill, but the belt is moving backwards faster than you can run.
So this is why the rich don't just hoard cash? I always wondered about that. You hear about billionaires and you never hear he has $5 billion in his checking account.
Never, because they understand this fundamental concept. They have a completely different mindset. The average person has a saver's mindset. Their goal is to accumulate cash. They see money as something to be held onto, to be protected.
That sounds like a safe and logical way to think, to be honest.
It sounds logical, but it's flawed. The wealthy have an investor's mindset. They see money not as something to be hoarded, but as a tool, as an employee. Their goal isn't just to have money, their goal is to send their money out into the world, to work for them, and bring back more money.
Okay, so you're saying instead of letting our money sit there and melt like that block of ice, we should be putting it to work. That's where investing comes in, I assume. But Sam, that word, investing, it scares people. It sounds risky. It sounds complicated. The stock market goes up, it goes down. My savings account is safe. It doesn't crash.
That's the most common and understandable fear, Jen. And you're right, a savings account won't crash in value, but as we've established, it's a guaranteed slow loss. Investing, on the other hand, involves short-term risk for the potential of long-term gain that outpaces inflation. And it doesn't have to be complicated.
So, what's the alternative? If not a savings account, where should a regular person be putting their money after they've paid their bills?
Let's break it down into a simple two-step process. First, I am not saying savings accounts are useless. They have one very specific, very important job: your emergency fund.
The rainy day fund.
Exactly. This is step one. Before you do anything else, you need 3 to 6 months worth of essential living expenses saved up. This money needs to be safe and easily accessible. A high-yield savings account is the perfect place for it. This is your buffer. If you lose your job or your car breaks down, you use this money so you don't have to go into debt or sell your investments at a bad time.
Okay, that makes sense. So saving isn't the enemy. Saving for a specific purpose, emergencies, is good. The problem is saving beyond that with no plan.
You've got it. The trap is thinking that your emergency fund is your get-rich fund. It's not. It's your stay-out-of-trouble fund. Now, for step 2, once that emergency fund is full, any dollar you save on top of that is a potential employee, and its job is to fight inflation and grow. This is the money you invest.
And where do you invest it? Do I have to become a stock-picking genius like Warren Buffett? I don't have time for that.
Absolutely not. For 99% of people, the best way to start is incredibly simple: low-cost index funds or ETFs.
You just used some jargon, Sam. Break that down for us. What's an index fund?
Think of it like this. You could go to the supermarket and try to pick the one brand of cereal that's going to be the most successful over the next 30 years. That's hard, right? It's risky. That's like picking a single stock, like trying to pick the next Apple or Tesla.
Yeah, I'd have no idea how to do that.
But what if, instead, you could buy a tiny piece of every single product in the entire supermarket for a very low fee? If the supermarket as a whole does well, your investment does well. That's an index fund. An S&P 500 index fund, for example, lets you buy a tiny slice of the 500 largest companies in America all at once. You're not betting on one company. You're betting on the American economy as a whole to grow over the long term.
So it's automatically diversified. It's spreading the risk out.
Exactly. It's the simplest, most proven way for the average person to build wealth over time. You set up automatic contributions every month and you just let it do its thing. You're not trying to time the market. You're just consistently buying your small piece of the entire economy. Over decades, the power of compound growth combined with fighting inflation is the undisputed champion of wealth creation.
So let's recap the Earnternet philosophy on this. The old advice, save your money, is broken. The new advice is more of a two-part strategy.
That's right. The modern wealth-building strategy is 1. Save an emergency fund of 3 to 6 months of expenses in a high-yield savings account. This is your shield, your defense. And 2. Invest everything else you save consistently into low-cost, diversified investments like index funds. This is your sword, your offense.
Shield and sword. I like that. So you're playing both defense and offense with your money. The saver's mindset is all defense, and they end up losing to the invisible enemy of inflation. The investor's mindset uses a smart defense and a powerful offense to actually move forward.
You couldn't have said it better. Stop thinking about saving and start thinking in terms of cash flow management. You manage your money to cover your present needs, protect against future emergencies, and build your long-term wealth. Hoarding cash in a bank account only accomplishes one of those, and it does it poorly.
This is a huge mindset shift, but it makes so much sense when you break it down. It's not about being risky. It's not understanding the real risk, which is doing nothing and letting your hard-earned money lose its power year after year.
That's the real scam, not the stock market. The real scam is being told that a 0.01% interest rate is safe when inflation is eating your lunch money every single day.
Incredible stuff, Sam. I think you just rewrote the first chapter of Personal Finance 101 for a lot of people today. So the key takeaway is don't just save. Save with a purpose, then invest with a plan.
That's the message. Your money should be working harder than you do. It can't do that sitting on the sidelines.
Well, that's all the time we have for today's episode of Earnternet. I hope we've challenged your thinking about money in the best way possible.
Thanks for tuning in, everyone. Don't let inflation win. Put your money to work. Join us next time as we explore another corner of the financial universe.
Until then, stay curious and make smart decisions. Bye for now.